When you buy shares in a company, you are said to be long the stock, and you want the price to go up, and you are therefore bullish. You buy the shares and then sell them at a later date for a profit. The opposite is true, and this is where the term short comes from. It means selling the shares in a company first and then buying them back at a later date for a profit. More detail on how we do this later. But essentially, you short the shares when you think that the share price of the company is going to go down, so therefore you are bearish on the stock as opposed to being bullish. Let's look at buying shares first. Most of us understand a trade as buying a stock when the price is low and then selling it back at a later date when the price has gone up for a profit. Now, your trade isn't complete until you've done both of these transactions. You've bought and then sold either for a profit or a loss. Shorting a stock is when you do these transactions the other way around. First of all, you sell shares when the price is high, and then you buy them back when the price is low, and you make a profit that way. Now, normally we live in a world where everything is positive and tangible, but in trading there's this mysterious negative world where we do things the other way around, and that's what shorting is. Let's look and see what happens to our account when we buy shares. So we've put $10,000 into our account to start with, and we buy 100 ABC shares. They're $12 each, so that's a cost of $1,200. So our balance goes down from 10,000 to 8,800. Now, at a later date, these shares have gone from $12 to $15. They've gone up $3. So when we sell them, we effectively credit our account with minus 100 shares. Notice the plus and minus here at work. We then have a cost which is effectively a credit of $1,500 or minus $1,500, and that takes our account up to $10,300, and that is our $300 profit. Now, this selling of shares is not shorting shares because you already have 100 shares to sell. When you sell ABC stock, you have a credit of minus 100 shares, which costs you minus $1,200, which brings your balance up to 11,200. It looks as though you've got some free money. But remember, the trade isn't over yet. You've got to buy back the shares at a later date. So let's assume we're doing that now. The share price has gone down to $9. We buy 100 shares plus 100 shares. This actually only costs us $900 now because they're $9 each. And this puts our balance from 11,200 to 10,300. We've still made our profit of 300, but we've done it by shorting shares, doing things the other way around. Basically, you sell shares that you don't own and then buy them back at a later date. So how is this done? Well, to short shares, you need a special type of account called a margin account. When you short shares, your broker borrows them for you and then sells them in a seamless transaction, which is just like buying shares, but you are using the shares that your broker has borrowed. Your broker then sells them and credits you with the extra balance that you saw in the previous example. Remember, the trade is only over when you buy back the shares and close out the trade. Usually, to open up a share account, you only need $100 or so. But to open up a margin account, you need much more, sometimes up to $25,000. And there's a reason for this. The reason for this is in an ordinary account, you buy shares, and the worst case is that instead of going up, the share price goes down to zero. Now, this is the absolute worst case. you would lose all your money if the share price went down to zero. However, when you sell shares, you may lose more money than you have in your account. When you sell here expecting the price to go down, and it does in fact start to go up, you're losing money. And remember, that stock price can keep going up. This is why we say that when you buy shares, your risk is limited because they can only go down to zero and you've lost all your money. But when you sell shares or sell them short, your risk is unlimited. They could keep going against you forever, and this is why you are required to have lots more money in your margin account. So there it is, a quick look at shorting shares.